Welcome back to Investing Talk Podcast. Today, we're taking a look at a company that has certainly grabbed some attention, Global Interactive Technologies. We're going to really try and unpack what's going on with this media tech company, give you a shortcut to understanding its current landscape.
It really is a fascinating case study. Textbook high-risk investment. And there are quite a few recent developments, some pretty wild stock movements, and maybe most importantly, a real lack of clear financial metrics to go through. Our goal here is really to boil all this down into clear insights for you.
Absolutely. And before we get into the nitty-gritty, if you find value in what we discuss here, please take a second to subscribe, maybe like and comment on this analysis. It genuinely helps us create more content like this. And if you're feeling particularly supportive, you could consider buying us a coffee. We always appreciate that. Okay, let's get into this. So first off, what exactly is Global Interactive Technologies?
Well, at its heart, it's a media tech company. They specialize in digital platforms, aiming to connect users around entertainment and culture.
And there's a big focus on K-culture and fandoms, right?
That's right. A very strong focus there. Their main product is Fan2. It's this interactive, multimedia social platform, content creation, community building, even e-commerce, all geared towards fans globally.
And they have other platforms too.
Yes. There's also Fanning, which is more about content discovery and helping creators monetize, and KoreaVibe.net. That one's purely focused on K-culture news.
So the positioning seems interesting, tapping into that whole global fandom thing.
It is interesting. It's a rapidly growing area, K-culture especially, with really high potential for engagement. Their idea is to have multiple ways to make money advertising, tools for users to monetize, and that e-commerce piece built right in.
Okay, here's where it gets really interesting, though, thinking about the stock. Back on July 3rd, GITS stock just exploded, up over 135% in one day.
An incredible surge.
Right, you'd automatically assume some massive news broke, a huge deal, a breakthrough, something. But then the company came out and basically said, nope, no material news caused that jump. How does that even happen?
Well, that kind of huge move, especially when the company confirms there's no news behind it, points directly to high volatility, maybe speculative trading. It tells you the stock price can be disconnected from the company's actual performance or fundamentals.
And wasn't there something else earlier this year? A stock split.
Yes, a reverse stock split. A big one. 1-for-20. This was likely done to keep their share price high enough to stay listed on Nasdaq. Exchanges have minimum price rules.
And that's usually not a good sign, is it?
Generally, no. A reverse split is often seen as a red flag. It can signal financial trouble, rather than, say, strong growth that leads to a forward split. It's more about compliance than fundamentals.
Okay, so high volatility, a reverse split. Let's talk about the fundamentals then, the financials. What are the numbers telling us?
Well, that's the problem, or part of it. Finding clear numbers is tough. For their latest revenue, the available sources just don't give specific figures. And finding a clear trend over multiple years is also difficult. There's just not much data provided publicly.
So a lack of transparency on the top line, how big of an issue is that when you're trying to evaluate a company?
It's a major issue. Revenue is fundamental. Without knowing how much money is coming in or how that's changing over time, it's incredibly hard to gauge the company's financial health or growth prospects. We do have some earnings data, though. For Q1 2025, their net earnings showed a loss of about $567,000.
A loss. Okay. And how does that compare?
That loss was actually down 86.1% from the quarter before it. So profitability took a sharp turn for the worse. It indicates a really negative trend in their earnings performance recently.
Wow. Okay. And that brings us to things like the PE ratio, price to earnings. Is there one for GITs?
Not really, no. It's listed as negative, around negative 1.2x, which makes sense. Given the losses, you need positive earnings for a meaningful PE. For context, the average PE for their sector is positive, around 7.7x, so they are way off the mark there.
Right. A negative PE just highlights the unprofitability. What about other key metrics? Debt, cash flow.
That's another area where information is lacking. Key things like the debt-to-equity ratio, free cash flow, return on equity, they aren't disclosed or reported in the sources we look at. We can guess about return on equity, though. Profitable tech firms in similar areas might aim for 8–15% ROE. Given GITS losses, their ROE is certainly negative, indicating they aren't generating returns for shareholders right now.
So a lot of missing pieces in the financial puzzle.
A significant lack of clarity, yes. Even their price-to-book ratio, which is around 1.2x, kind of in line with the sector, might be misleading. Given the losses, the market might actually value their assets below book value. It's a sign of skepticism.
Okay, let's shift gears slightly. Beyond the financials, what about the people running the company? Management, governance, any issues there?
There seems to have been some turbulence, yes. Sources mention recent executive changes, including replacing the CEO. That kind of instability at the top can be disruptive.
Definitely raises questions about strategy and consistency. And any external pressures, regulatory stuff.
Yes, they've faced some of that too. Back in April 24th, 2025, they got a delinquency alert from Nasdaq
Why?
for filing their 2024 annual report late. They did fix it quickly, regain compliance by April 30th, but still, missing deadlines isn't ideal.
And anything else?
More significantly, perhaps, in late June, they faced scrutiny from Korean authorities regarding securities law compliance. This led to a fine. Now, the company's appealing that decision, but it represents a more serious regulatory issue in their home market.
Okay, so a late filing, which they fixed, but also this ongoing issue in Korea. What does all this add up to for someone looking at the company?
It adds layers of risk. That Korean regulatory action, especially if it's not resolved favorably, could really hurt their reputation and potentially their operations.
Yeah.
Plus, earlier in the year, back in February, GITS took on some debt through an agreement. That could put more pressure on their finances down the line. And you combine all that with the leadership turnover. It just creates a lot of uncertainty about their future direction. And for a tech company in a fast-moving space, that's critical.
So putting it all together, the volatile stock, the reverse split, the missing financials, the leadership changes, the regulatory issues, how would you summarize the risk profile here?
Extremely high risk. I mean, you have the volatility, almost like a penny stock. You have the reverse split, often a sign of weakness, the leadership churn, the clear lack of profitability right now. And it's still not entirely clear how well their actual business model is gaining traction, despite the platform sounding innovative.
But on the flip side, there must be some potential opportunities, right? That K-culture market is huge and growing.
Absolutely. That's the potential upside. Their unique focus on K-culture and fandoms is a genuine strength. It's a massive, passionate market. And it's a big if, they can sort out the legal problems, stabilize leadership, and maybe launch some really compelling new features or partnerships within Fan2 or Fawning that could drive user growth and maybe, eventually, revenue.
So the core idea still has appeal. What's the general feeling in the market? What's the sentiment?
It seems pretty mixed, leading towards negative right now. Most of the recent news focuses on the regulatory problems, not on growth or success stories. You see some investors being very cautious because of all these issues. Others might see a potential bargain if things turn around. There's general agreement that these fandom platforms have potential in the long run, but the consensus is that GITs needs to show it can actually make money, and soon.
How do they stack up against competitors? You mentioned Weverse or VLive earlier.
Compared to bigger players like Weverse, which is linked to HYBE, or Naver's VLive, GATs tries to stand out with maybe deeper e-commerce integration and a more global-first approach from the outset. But realistically, they are currently much smaller in scale, and crucially, they aren't profitable like some of those established competitors. They lag behind significantly right now.
Okay, so we've covered a lot here on global interactive technologies. It's a real mix. On one side, you've got this company in a potentially huge, exciting market, K-culture, global fandoms. The platform idea sounds interesting.
Right, there's clear potential in the niche they're targeting.
But then on the other side, it's just loaded with red flags. The missing financial data, the losses we do see, the reverse split, the leadership changes, these regulatory headaches.
Right.
It really weighs things down.
It does, and based on the available information, the most sensible stance seems to be a hold for anyone already invested. Meaning, maybe wait and see, but it's probably too risky for new money right now. There needs to be much more clarity on their path to profitability or how these legal issues get resolved before it looks like a solid investment. They really have to prove they can turn that platform engagement into actual sustainable profit.
It's a classic dilemma, isn't it? How much do you bet on the potential, the story, the market niche, versus the cold, hard facts of the financial statements or lack thereof? Especially in tech, where things change so fast. It makes you really think about how you weigh that promise against the current reality on the balance sheet. That's definitely something to consider for any investment. And that's our look at global interactive technologies for today.